Assalamu alaikum friends, welcome to 8th part of IFRS 9. Today we are going to discuss derivatives and embedded derivatives. What are derivatives? Derivatives is the one which has the following characteristics. So let us go through the characteristics of derivatives. Its value changes in response to the change in a specified interest rate or a security price or a commodity price, foreign exchange rate, index of prices or rates, credit rating or credit index or similar variable called the underlying. Okay, so value of that derivative changes in respect to all these things. It is dependent on all these variables. It could be interest rate, it could be a commodity price, it could be foreign exchange rate, anything. Next, it requires little or no initial net investment relative to other types of contract that have a similar response to changes in market conditions. What does it mean? What are the examples of derivatives? If you are right in your financial management, you must have gone through, or even in your AFM, in detail, you must have gone through the derivatives. For example, forward, you have currency forward, you have options, you have future, you have swap. All these are examples of derivatives. Okay. And it is settled at a future date. We always settle derivatives at a future date. For example, if you are going for an option, that option, if you are taking an option for 2 years, not 2 years, let's say for 3 months. So that option you will exercise after 2 months, right, in the future. Or you must, you took a contract, you went in under the future contract to purchase a given currency in order to protect yourself from or hedge yourself from exchange rate risk management. Sorry, exchange rate risk, right? So these are some features of derivatives. It will be settled in the future date. Next, if you are having a contract to buy or sell a non-financial item, okay, what are non-financial item? It could be inventory, it could be property, plant and equipment. Okay, so if you are having a contract to buy or sell those items, then a contract to buy or sell a non-financial item is only a derivative if these two conditions are satisfied. What is it? Number one, it can be settled net in cash, or you are using another financial asset, so it can be settled in cash as well as in financial asset. And what's the next thing? For example, if you have to buy an inventory or if you have to buy a property, plant and equipment, you have a contract to buy. How are you settling it? In cash, right? You give cash, you take the property, plant and equipment. Or you might give them your financial asset and take the property. So you can exchange financial asset also. Okay? And means both the conditions needs to be satisfied. The next one is the contract was not entered into the purpose for the receipt or the delivery of the item to meet the entity's operating requirements. The contract was not entered into for the purpose of receipt or delivery of the item to meet the entity's operating requirements. You are not there for the operating requirements. Okay, that means for your daily requirements. If it's daily requirements, then it's not a derivative. If you are having a contract, for example, then it will be dealt under IFRS 15 as a revenue. Okay, when you are buying goods or selling goods, okay, and if you have a contract to buy or sell goods, then that's not called a derivative. That is not called that's not a derivative. That you record under IFRS 15 as revenue. Okay. So IFRS 9 says that a contract to buy or sell a non-financial item is considered to be settled net in cash when? How can you say it's settled on net in cash? When these following things are there. Number one, the terms of the contract permits either party to settle the contract in net. The term, see, the term of the contract will be given to you in the case study. They will tell you whether it will be settled in net or not, or whether it will be settled in something else. Okay, so it has to be settled in net Okay. So the terms of the contract promise either party, any one of the party should settle it in net, should settle the contract in net. Next, entity has a practice of setting similar contracts net. Even in the past, they should have been settling the contract in net. Third, for similar contracts, they have a practice of taking delivery of the item and then quickly selling it in order to benefit from fair value changes. What does this mean? For similar contract, okay, has a practice of taking delivery of the item. That means they take the goods or services under the contract, and then what do? Simultaneously, they are selling also. They are taking the goods and services. They are selling also what? They are selling their financial asset. So they are not settling in cash, but they are giving their financial asset. You can say, okay, and then quickly selling it. Sorry, I'm not sorry. This is not financial asset they are selling. They are selling that good or services only which they have taken it on delivery. They are selling it quickly. Why? In order to benefit from the fair value changes. The fair value will change. So in order to benefit from that fair value changes, they are quickly taking it and quickly selling it also. Next, the non-financial item is readily convertible to cash. You can change it to cash. But if the contract is not a derivative, what should you do? So whenever in IFRS 9 a contract is mentioned that this is a contract, your first job is to see whether it's a derivative or not. So if the contract is not a derivative, then it was a simple executory contract. You should know what is executory contract, because executory contract you cannot use IFRS 9 to deal with it. So such contracts are not normally accounted for until the sale or purchase date. Okay, executory contract you do not settle until the sale or the purchase date. What does conceptual framework says on it? Conceptual framework defines an executory contract as a contract that is equally unperformed. You are not performing the contract. This might mean that neither party to the contract has fulfilled any of its obligations. That is the meaning of executory contract. None of the party are fulfilling their obligations. One example would be that a contract to pay employees $10 for every hour that they work. So if the employer has not yet worked any hours, then the entity has no obligation to pay the employee. So neither the employer, neither the employee, they are not fulfilling their obligations. Employee didn't work, so he didn't fulfill his obligation. Employee also didn't pay the $10, so he also didn't fulfill his obligation. Both the parties did not fulfill their obligations. It is known as executory contract. It is not a derivative. Okay, so executory contracts are not normally recognized in financial statements unless they are onerous, in which case a provision should be recognized. So if it is, they are normally not recognized, but if they are onerous, then you have to recognize a provision according to IS 37. This term is explained in detail under IS 37. Okay. Now let us go to some common examples of derivatives. You must have gone through this in your financial management, and also in AFM also you will go in detail. Forward contract, future contract, swap, options. So I don't think I have to explain in detail. Forward contract is today you are fixing a rate. Fixed rate that in the future you will be receiving or you will be paying this much. Okay, specific amount. This so forward can be used for both exchange rate and interest rate, right? It's like you are hedging. You're protecting from future movements in exchange rates and also interest rates. In financial management or in AFM, you'll be studying this in more detail. But here we don't have to know all those things. Here, what you need to know is that forward contract is a derivative. That's it. Future contract is also similar to forward. The only difference is for future comes in standard size, not like forward. Forward is like over the counter. It's like more like customized. Future is not customized. Future is standard. It will be same for everyone. Swap. One party is swapping with another party, the counterparty. For example, with interest rate, you may be paying interest on a fixed rate, the other one will be paying variable rate. So you might get a counterparty and swap with each other. An option. Option You can exercise or you do not exercise. It depends on the rate. If it's favorable in the future, it could be interest rate, it could be exchange rate. If it's favorable in the future, you exercise the option. If it's not favorable, you do not exercise the option. You let it lapse and still take the benefit. Okay. So these are some four common derivatives. Now, how do you measure those derivatives? So on initial recognition, okay, derivatives should be measured at fair value only, and transaction costs are expensed. At the reporting date, what about the reporting date? You will always have two measurement. One is on the initial recognition, the other one is at the reporting date for all any standard. You need to remember it like that. So at the reporting date, derivatives are normally reporting date is after 1 year, right? After within 12 months from the initial recognition, but sometimes it could be less than 12 months. Derivatives are remeasured to fair value. Again, it will be remeasured to fair value. So the movement in the fair value will be recognized in profit and loss as a gain or a loss. Now, accounting for derivatives. Let us go through an example to understand this better. Entity A has a reporting date of 30th September. It enters into an option on 1st of June 2005 to purchase 10,000 shares in another entity on 1st of November 2005 for $10 per share. So the moment you see the option, you know it's a derivative. The purchase price of each option is $1. So how are you going to record this? You have to pay cash, remember. For option, you have to pay a premium to purchase that option. So that means your cash will be credit, and option, you are purchasing the option. So you need to debit that option. So it is 10,000 into 1 because 10,000 shares you are purchasing and the purchase price is 1. So 10,000 into 1, 10,000 debit option and cash 10,000 you have to credit because you need to pay cash to purchase the option. Next, 30th September, by 30th September. So how many? From June to 30th September, the fair value of each option has increased to 1.3. This is not an answer. This is in the further to this, okay? They have continued here. So how to show that increase in fair value? You need to credit in the P&L because increase an option you are debiting it. Okay, because the option value also will go up because of that fair value. What is the difference? Share price is 1, but fair value increased to 1.3. So the difference 1.3 minus 1 into 10,000. Therefore 3,000 option debit, 3,000 profit and loss credit. Now on 1st of November, the fair value per option increased to 1.5. Share price on the same date is 11.5. A exercises the option on 1st of November and the shares are classified at fair value through profit and loss. Okay, because you know what are shares? Shares are equity instruments. So equity instruments you can either measure it at amortized cost or fair value through profit and loss. Here they have already told that fair value through profit and loss. Okay, so financial assets are recognized at fair value. So the shares are initially measured at. We know that financial assets they are recognized at fair value. That means okay because this is fair value through profit and loss. So financial assets you will be recognizing at fair value. So the shares are initially measured at 10,000 into 11.5, the share price only. Okay. So investment in share you need to debit. Investment in share means this is a financial asset only. Okay. At fair value, 150. Then credit cash. How much? Because you have to pay cash. How much? 10,000 into 10. Because here if you see on 1st of November 2005 for 10 per share. Okay. They are going to purchase shares in another entity on 1st of November for 10 per share. That's why on that day, 1st of November 2005 only they are exercising the option. So on that day, you have to pay cash 10,000 into 10 to exercise the option. So 100,000. Option, you need to again credit this time. This is not debit. You need to credit option this time. 10,000 plus 3. Why? you have purchased option, but on 1st of November you are exercising the option. That means that option is not there anymore. That option is replaced by this investment in shares at fair value, which is a financial asset, right? So this option now you need to take it on the credit side. Earlier you debited 10,000. 10,000 you debited here because it was an option earlier. Now you exercise, so no, there is no more option. It needs to be cancelled out. That's why 10 plus 3, 13,000 on the credit side. And profit and loss, the gain on the option. What is the gain on the option? From 1.3 to 1.5. So 2,000. Okay. Now let us go to embedded derivatives. Derivative part is easy, but hardest thing is in the embedded derivative. It's a little bit complex. What is the definition? As you know, embedded derivatives means it's the combination of two things in one. It's like a hybrid contract. Okay, so embedded derivative is a component of a hybrid contract that also includes a non-derivative host, with the effect that some of the cash flows of the combined instrument vary in a very similar to a standalone derivative. Okay, with the effect that some of those cash flows of the combined instrument may vary in a very similar to standalone derivative. So it has a derivative and a non-derivative under one contract only. Partially it is non-derivative, partially is derivative. So how do you account for it? If the host contract is within the scope of IFRS 9. Okay, not all the contracts are within the scope of IFRS 9, but if it is, the host contract is within the scope of IFRS 9, then the entire contract must be classified and measured in accordance with that standard. Entire contract. Okay, if the host contract is not within the scope of IFRS 9, what do you mean with not within the scope of IFRS 9? For example, it is not a financial asset or a liability. Okay, it's not a financial asset also, it's not a financial liability also. That means you cannot use IFRS 9 to deal with that contract. You have to use some other standard. Okay, here if it is within the scope of IFRS 9, okay, the host contract, then the entire contract must be classified and measured in accordance with that standard. And here if it is not within the scope of IFRS 9, then the embedded derivative can be separated out and measured at fair value through profit and loss. You need to separate the embedded derivative out and measure that at fair value through profit and loss. Okay, so here you are using IFRS 9 for the entire contract. Here you need to separate out if it is not within the scope of IFRS 9, the host contract. You need to separate out and measure at fair value through profit and loss if these conditions are there. Economic risk and the characteristics of the embedded derivative are not closely related to those of the host contract. Okay. The economic risk, number one, and the characteristics of the embedded derivative, they are not closely related to the host contract. Then you have to measure at fair value through profit and loss. Second, a separate instrument with the same terms as the embedded derivative would meet the definition of a derivative. And the entire instrument is not measured at fair value with changes in fair value recognized in profit. The entire instrument is not measured at fair value with changes in fair value recognized in profit and loss. In that case also, under all these three conditions, you have to recognize, you need to separate out the embedded derivative and measure it at fair value through profit and loss. Because of the complexity involved in splitting out, it's not easy to split out and measuring an embedded derivative. IFRS 9 permits a hybrid contract, okay, where the host element is outside the scope of IFRS 9 can be measured at fair value through profit and loss in its entirety. because it's hard to split out. What is IFRS 9 saying? They are permitting that where the host element is outside the scope of IFRS 9. That means it's not a financial asset, not a financial liability. What should you do? You can still measure it at fair value through profit and loss as a whole, the contract as a whole. Okay? And for the vast majority of embedded derivatives, the whole contract will simply be measured at, for most of the embedded derivatives, the whole contract is measured at fair value through profit and loss. So definitely you will not understand this by reading. You need to do questions on this area to understand this better. There is one example, right? And that's it. So with this, we'll be finishing our derivatives and embedded derivatives. Before we move on to the last section of IFRS 9, which is hedge accounting. Hedge accounting in itself is a big topic. Okay, so an instrument in convertible bond. An entity has an investment in a convertible bond, which can be converted into a fixed number of equity shares at a specified future date. Okay. What is a convertible bond? First of all, your job is to know what is a convertible bond. Is it a derivative instrument or not? What type of contract it is? The bond is a non-derivative host contract. Okay. Non-derivative host contract. Bond is non-derivative. And the option to convert to shares is therefore a derivative contract. Can you understand now? What is the meaning of embedded derivative? This is known as embedded derivative. You have a derivative also, you have a non-derivative also. What is derivative? Derivative is the option that you can convert to share in the future. That is the derivative element. What is the non-derivative element? Convertible bond. Bond. That bond is a not convertible bond. The bond itself is a non-derivative. Host contract. Why host contract? Now let me tell you what is the meaning of host contract. Because by now most of you will be confused thinking what is host contract. Why I didn't define you the host contract? Because I want to make you go through this example. Host contract means what is your main contract. Okay, option comes inside that, inside the convertible bond, but the main contract is the convertible bond. Okay, so that is known as host contract. That means inside that there is another element which is derivative element, which is option, but option is not the main contract. The main contract is convertible, the bond which you can convert. So that non-derivative is known as host contract. Sometimes it could be the derivative which is the host contract, sometimes it is non-derivative which is the host contract. Most of the time it is the non-derivative which is the host contract, and inside you might have some derivative element. For example, like this, you have an option inside that. Okay, so now the host contract is the bond. Can you understand? The host contract is the bond. This is the main contract. Okay, the bond. And you know what is bond? Bond is a financial asset. Most of you get confused thinking that how bond is a financial asset. Bond is a financial liability, or some might say bond is a debt instrument. Yes, it is a debt instrument. I understand it's a debt instrument. It's a financial asset which is a debt instrument. Bond is a financial asset which is a debt instrument. Financial asset could be two types. One is equity investments, equity instruments, the other one is debt instruments. Earlier it was, remember here, we went through shares in the derivative part in this example. Enter into an option to purchase shares. That is equity instrument. Financial asset in equity instrument. This is financial asset which is a debt instrument, the bond. Okay. So bond is a financial asset, and so is within the scope of IFRS 9. It is, so you always have to see if the host contract, okay, is within the scope of IFRS 9 or not. Host contract is bond, bond is a financial asset is within the scope of IFRS 9. Okay, because it is in the scope of IFRS 9, the whole contract you have to apply IFRS 9. Okay, so this means that the rules of IFRS 9 must be applied to the entire contract. Okay, that's what we went through here. Even last sentence also says that for the vast majority of embedded derivatives, whole contract will be measured at fair value through profit and loss. Okay, but before that, yes. If the host contract is within the scope of IFRS 9, entire contract must be classified and measured in accordance with that standard. For example, that means that standard means IFRS 9. Okay, but if the host contract is not within the scope of IFRS 9, then only you have to separate out the two elements. But here you don't have to separate out because it is a element of IFRS. It is in within the scope of IFRS 9. Okay, so the bond would fail the contractual cash flow characteristics test, and therefore remember bond. Okay, financial asset. You can measure it in two ways. One is fair value through profit and loss. The other one is amortized cost. But here, first, always you have to see whether you can apply the amortized test or amortized or not. Then only comes the fair value through profit and loss. That means you have to do a test to decide whether amortized cost will apply or not. The bond would fail the contractual, they will fail the contractual cash flow characteristics test. Why? Why? Because bond is this is not a normal bond. This is a convertible bond. That means you can later, you'll be sharing it to a number of shares. That means you will not be receiving cash flow anymore. Right? That contractual cash flow will not be there anymore once it is converted to share. That's why they have failed that contractual cash flow characteristics test. That means you cannot use amortized cost. You have to use the fair value through profit and loss. Okay, and therefore the entire contract should be measured at fair value through profit and loss. You see now? Does it make sense? Yes. You can measure it at fair value through other comprehensive income also, but for that you have to make that designation. You have to elect for it that you are going to measure the fair value through OCI, and it's an irrevocable election. That means later you cannot change it. Okay, but here they didn't mention anything about that election and all. So it is amortized cost or fair value through profit and loss. Amortized cost also you cannot take it because they have failed the characteristics test. They're not going to receive cash anymore after you convert to shares. In short, convertible bond you cannot measure at amortized cost. They will always fail the contractual cash flow characteristics test. Therefore, they are always measured at fair value through profit and loss. This is the simplest way you can remember about convertible bond. So if you want to understand derivatives, embedded derivatives, especially embedded derivatives, again, if you want to go through this, you didn't understand any of this, just go through this example once more. This will clear all your doubts. This is the easiest example. And this is the only example given, because after that, if you say the next topic is hedge accounting, that will be covered in the next video. And that is the last section also in IFRS 9. After hedge accounting, IFRS 9 is completed. And if you're having a problem, because by now I have done financial asset long time ago, so by now some of you might have forgot the rules and all, you need to go back and revise it again and come here. And also your bond and all those things. Because if you're not thorough with those knowledge, the sound knowledge, what is financial asset, how it is valued, what is bond, how is it valued, bond is what, it comes under what is a convertible bond. If you're not good with it, you cannot understand derivatives or embedded derivatives. So first you need to come through the basics. How financial liabilities, financial instruments, financial assets, how they are measured, recognized. Okay, but if you have a very sound understanding of those areas, trust me, embedded derivatives, even hedge accounting will not be so tough. It will be easier for you because it is built upon those basic concepts only. Okay, so that's it for derivatives and embedded derivatives. See you in the next part, hedge accounting. And hedge accounting is definitely going to be a long video, so make sure that you come prepared for it. So till then, take care and don't forget to subscribe to my channel. So what just happened is that I forgot to do this question on embedded derivatives. So let me finish this question. This is only testing understanding for this section before I move on to hedge accounting. Hogarth priced 100 options on 1st of January 2006 for 5 per option. Each option gives Hogarth the right to buy a share in rolling on 31st December 2006. That's exactly 1 year for 10 per share. How should this be accounted for given the following outcomes? First, options are sold on 1st July 2006 for 15 each. On 31st December 2006, rolling share price is 8. and how get less the option lapse unexercised. Third option is exercised on 31st December when down in share price is 25. The shares are classified as held for trading. So let us go to the first scenario when you're selling the option on 1st of July 2006. When are you buying the option? 1st of Jan 2006. So it will be there till 30th June. That means for 6 months you'll be having the option. You're buying 100 options for 5 each. Okay, and then you're selling it 15 each. So how are you going to recognize the first one? Before that, you have to understand that this is a derivative. Option is a derivative. How do you account for derivative? At fair value, right? So in all the scenarios, the cost of the derivative, that means the cost of the option on 1st of Jan 2006 is 500. 5 into 100. Okay. And the asset is recognized in the statement of financial position. See, whether you exercise the option, whether you don't exercise the option, whether you sell the option, under all these three, cost of the derivative in the beginning is 5 only, 5 into 100. Okay, because premium you have to pay whether you exercise, whether you sell, whether you don't exercise. So 5 into 100, 500. Next, what are you recognizing? You need to recognize an asset. What is the asset? Asset is the option. So you see, it's not actually an asset, but we are taking it as an asset. The option is the derivative. We take it as an asset. It could be any derivative, okay? Option, forward, future, and all. But in this case, it's an option. So that is taken as an asset which you are debiting, and credit cash because you have to pay the premium. This is before taking any of the scenarios on 1st of January 2006. This is the scenario. Now let us go to the outcome A where you are selling the option for 15. Okay. So if the option is sold, 15 means 100 into 15,500. Before the exercise date you are selling it, you have to de-recognize the profit of 1,000. Because the cost initially was 500, you are selling it for 1,500. That means you are recognizing a 1,000 profit, right? The difference is the profit of 1,000. You de-recognizing it, but you are recognizing a profit when you're selling the option. So 1,000 is the profit. Next, you are receiving cash. You are selling it for 1,500. So debit cash. And what is the cost? That means this which you have debited here, now you need to credit here. Because there is no more option. You are selling that option. It's like you are selling an asset after you bought it. So you need to credit it. 500. Coming to outcome B. Okay. Outcome B, if the option lapses, unexercised, you're not exercising the option, then what should you do? Then it is de-recognized and there is a loss. Okay, you're not exercising the option, so it cannot be an asset anymore for you. You need to credit that asset, the option 500 from the beginning. You have to take, okay, this one. From here only everything comes A, then B, then C. You're not comparing from here A to B. Okay, and you need to debit. It's a loss of 500. Why? Because you have incurred an expense of 500. You bought an option at 500. At the end you're not even exercising the option, so it's a loss for you. 500. Now coming to outcome C where you are exercising the option. You are exercising the option at 25. So here the option is exercised. You have to de-recognize the option. Instead you are recognizing an investment. So the entity records the cash paid upon exercise and the investment in share is recognized at fair value. That investment you are recognizing instead of the option. And immediate profit also is recognized. So what are you debiting? Asset, but this time this is not an option, this is replaced by investment. 100 into 25. Cash, you need to pay cash for it, for that investment in shares. 100 into 10. Okay, because they buy a share on rolling on 31st December for 10 per share. You see, that's why it's 100 options into 10. Next, that option is no more, it will be credited now. Okay, instead of this you are recognizing an investment. Now there is a profit of 1,000. How? You can say it's a balancing figure. That way also you can calculate, or otherwise you can go like this. 20, just 6,000. The shares are close over share the profit. 10, 25, 10. Okay. You are recognizing a profit immediately because you are exercising the option. Okay, because you are exercising the option. So I am recognizing this one, which is this 1,000. Okay, this 1,000 cash which you have paid for that investment. Now you are recognizing 1,000 profit because you are exercising the option. So now that premium it's a profit for you now. Okay, so it's 1,000. And one more thing before I enter this question, I thought that a more clear explanation is required on these 3 points, because now since we have done that question, we went through that example of convertible bond. Now we can understand these 3 points better. So I thought of going through it again. Okay, the economic, okay, these are the three conditions which says that you need to separate out the embedded derivative from the host contract. The economic risk and the characteristics of the embedded derivative are not closely related to those of the host contract. You see, that means if the economic risk and characteristics are not same, then it's better to separate out, right? If you are keeping it together, it will not work out. Sometimes you don't have to separate out, even if the host contract is not within the scope of IFRS 9. You don't have to separate out from the embedded derivative. But if these three conditions are there, then you have to separate out. Okay, and this can be asked as a theory question from you, because it was asked from me once, I remember. So luckily I remember this point. I was able to, you have to define or justify whether you have to separate out or not. So you have to separate out if the economic risk of, let's say, the host contract, let's say in the convertible bond, the risk of the bond and the risk of the option of converting it to shares, if they are not same, if they are different, their characteristics are different, then you have to separate out. Okay, because if it is same, if it's similar, then you don't have to separate out. Second, a separate instrument with the same terms as the embedded derivative would be the definition of a derivative. That means in the embedded derivatives, okay, you have a derivative also, you have a non-derivative also. Okay, so you have a separate instrument now that has the same term as that embedded derivative. Okay, that, but in the embedded derivative you have two things, derivative as well as non-derivative component. But in that you have two, but now you know that this is a separate instrument which has the same terms. That means the definition of a derivative, that separate instrument is a derivative. So you need to separate out. Why? Because in that embedded derivative you need to know for the derivative element, you can refer to this separate instrument to find out, because they are in the same terms. Okay, for example, I don't know whether this is clear to you or not. Let's say A and B. In A, there is only derivative only, and B has non-derivative ND plus derivative. Okay, but for A's derivative the terms are similar to this, they are similar to the terms of this derivative. Okay, the terms in the B, but because there is an ND also with the D, you cannot work it out. You need to separate out now. You see, you need to separate out ND and D. Now you can use these terms as well as this term. They are similar, right? If they are similar, then you have to separate out. Third one, the entire instrument is not measured at fair value. That means entire instrument means it has non-derivative plus derivative, like the convertible bond we went through. Both option to convert to shares and the bond. Both are not measured at fair value with changes in the fair value recognized in P&L. Then what should you do? You have to separate out. You have to separate out and measure it at fair value. If the entire is not measured, you have to separate out. Still you have to separate. So these are the three conditions you have to separate, both derivative and non-derivative element. Okay. Now I would not say non-derivative, I would say the host contract which is not within the scope of IFRS 9, you have to separate out from the derivative. Okay. Definitely there's a derivative in that. That's why it is known as embedded derivative. Okay. So these are the three conditions. If it's there, you have to separate out. Imagine if it was the opposite. Reverse the condition now, you don't have to separate out. For example, economic risk and characteristics are now related. Now they are related, they're same. Same to the host contract. Don't separate out. If there is no separate instruments with same terms, do not separate out. Third one, entire instrument is measured at fair value. Do not separate out. Okay, so can you see that? It's just that you have to learn it that way. That's it. So this is nothing hard. It's very easy. And don't worry too much about this aspect, because if a question comes also, maybe it will be around 5 or 4 marks like that. Max. More than that, on this area, question does not come. Means embedded derivative or even a derivative, but mostly it is embedded derivative. Derivative I haven't seen so far a question, but embedded derivative definitely I can tell you, because when I was giving my SBR exam, I definitely got a question on embedded derivative. I think it was for 5 marks, where I have the same question I got, that I have to tell whether under this condition embedded derivative have to separate out or not. Some conditions were there, and then I had to tell all these points. Okay, so that's it, and see you in the next which is hedge accounting.